Okay, so we are talking about the status of the internal audit department, right? So what is the status? The status of the internal audit department. What do you mean by the status? We are looking at, when we say the status of the internal audit department, we are referring to the objectivity, you know, what is their status in terms of their integrity? That's what we are referring to here. So we are looking at the objectivity of this IA department or internal audit department. We're also looking at their professional competence. You know, their professional competence. Who are these people who are in internal audit? You know, what kind of experience do they have? What kind of qualifications do they have? Yeah. It's very, very important. It's very, very important. Okay. Then you also have another consideration is that there will also need to be effective communication between external and internal auditors. You know, if you decide to use the work of internal auditors, it means that there's going to be that collaboration. You know, and so that collaboration must be there, that communication must be there, and that ability to communicate must be there, because you will notify each other of, you know, any matters, you know, any matters arising, you know, the external auditor will bring it to the internal auditor's attention. Any question on this slide? Any question on this slide?
My question is the first point as to using the work of the internal auditors. What the external auditor needs to consider. The first one, the status of the internal, the objectivity of the internal audit department. In practice, how are you able to assess the integrity of the internal audit? It's just something that was the question I was asking in my mind when we got to that point.
Okay, that's a good question. So let me throw the question back to you. How do you think you assess the integrity of management? How do you think the auditor does that? Do you have an idea? Hello.
I don't have an idea, but I just want to try.
Okay. Oh, let's
maybe
try.
By having a discussion with management to find out management's point of view of issues. Yeah. Is that a fair point?
Okay, that's a fair point. Does anyone have an idea? How do you, it's a good question that I asked. I just want to see what you.
Well, if it's not the first time.
Hello.
Okay. After I heard another person talking, so after Caleb.
Yeah. Okay.
So,
I was saying you can assess the objectivity of the internal audit department by examining examining the independence of the internal audit department. For example, whether the internal audit department reports to the audit committee or it reports to, let's say, the management, the finance director. So if it reports to the audit committee instead, then you know that they are more independent, so their decisions will be more objective. and then you can also assess its status or its objectivity in the sense that when reports are made, like if the internal audit department, they make recommendations on certain things that management are supposed to do. If management take up these recommendations, you can rely more on this thing. But if management is not really taking these recommendations by the internal audit, then you can the independence is kind of compromised. So you check that one too.
Okay, those are very good points. Very, very good point. Okay, Caleb. I'm using that so that I come to how to assess objectivity of the internal audit department. Because it's quite similar. That's why I'm doing that. Okay, go ahead.
So, if it's not if it's a recurring audit engagement, that's not the first time the auditor has audited the client. They can use, first of all, the internal controls of the organization, because it's the auditors that help management put in basically good internal controls. Also, has my colleague also made mention of how they communicate, or their reporting structure. That is, they also need to know who they report to, or who they report to, and how they take their reports. However, if it's a more or less like a new organization that you're going to audit, then basically is also going to look at again, you can also look at the internal controls. However, you can also talk to the chief internal auditor and discuss how matters are being resolved. For instance, okay, you can put to the floor that, okay, how, if there's an issue with revenue, what was put in place, and due to probably your experience in certain firms, how they take those issues. So you can also take a look at that.
So I think you guys have answered the question already. So you do that, you assess the to my friend's question, you assess the is it objectivity? Yeah, objectivity of the internal audit department through several ways. Number one, is it objectivity and competence, whatever you want to, objectivity, competence. One, structure. Structure talks a lot about competence, right? So the reason why you don't feel comfortable when you go to a public institution because you don't see any structure there. Some of the public institutions is just a mess. You don't know who is assistant. They are just there, and there's one boss. So where the structure and the reporting lines haven't been clearly defined, it's likely to reflect in the kind of work they do, because there's no system, there's no structure to manage the way the work is done. I think Caleb and the other gentleman mentioned that, but in a different way. So that's one. Number two is you assess them by you look at the facts on ground, right? One of the things that so you need to understand as an external auditor, what are the responsibilities of an internal auditor? There are certain things that they are responsible for. Okay. And some of those things, they are facts on ground. So one of them is the controls, right? The internal audit team is supposed to look at the processes of the organization, perform audits, and they are very, very key in helping to design controls that would help the organization. So you look at those controls, like they say, right? The way you're able to observe the mechanic is good is that was he able to fix the car? So you look at those controls, look at the way those controls are, designed and the way they operate. And you can tell that, the internal audit team, there's a problem or there's no problem. So sometimes when auditors go into an organization, they look into, in practice, they look at the internal auditing. Sometimes it's only one person. So that's about the structure. It's only one person in a big organization doing everything. So you can tell that it's either this one person handling the whole internal audit. It's either this person is going to be pressured and might make mistakes as a result. It's not very, so it sends a signal. These are signals that the auditors pick. Sometimes they look at the controls, they ask questions and they look at the controls and they're able to tell how competent they are. Another thing that one of our friends raised, which I thought was very, very key, is how independent they are, right? So you don't want an internal auditing that is easily influenced. So there's a reason why they report to the audit committee and they get, so you don't want an internal audit team that is easily influenced, so that when the management is doing something fishy, the internal audit team will cover it. So you want an internal audit team that is a bit independent or semi-independent so that they can easily run audits, just the same way an external auditor is independent in an organization. You want that for, and if that independence is compromised, competence, objectivity, all those things are compromised. I hope I answered your question. Did I answer your question? Is he still online? Okay, I think I answered the question. I don't know. If I didn't answer, just let me know. Now let's move on to using the work of using the work of internal auditors. We're still talking about it, right? Because the external auditor is fully responsible for the audit opinion, you need to test the work performed by the internal auditors. So in practice, what happens is that, so this is also another way that they can check the objectivity, competence, or whatever. When the external auditor is relying on the internal auditor's work, he doesn't swallow, that's what I was trying to say. They don't swallow everything hook, line, and sinker, right? It's like they retest. It's like remarking, right? Somebody writes an exam, an examiner marks, then another examiner marks again. So they get the work of the internal auditor and they test the work that has been performed by the internal auditors. Before using specific work of internal audits, the external auditor is required to evaluate whether the work was performed by internal auditors with adequate training and proficiency. So who is performing the work? Does the person have the training? Is the person proficient enough to be able to handle the work? Another thing is that, was the work supervised properly? Was the work supervised properly? So you want to understand whether the work was supervised. Was the work supervised properly? If it wasn't supervised, then who is catching the errors in the work? Another thing that the auditor also evaluates, whether appropriate conclusions have been reached and whether adequate audit evidence was obtained. It's very, very important. Then if there are any exceptions, or unusual matters, that is something the auditor really takes note of. So how does this, so I put up a small note down there. If you see, I said procedures to achieve this, procedures to achieve this is by examining items already examined by internal audits, which we already talked about, testing the work performed by internal auditors, then examining other similar items as well, and observing procedures performed by internal audits. So these are some procedures that auditors can engage in. Now, to determine the planned effects of the work of internal audit on the nature, timing, and extent of the procedures, the external auditor is required to, again, like when we are talking about auditors experts, we mentioned the nature and scope of specific work performed or to be performed by the internal audit. You know, well, what is the work? What is the nature of the work? What is the scope of the work? It's very, very important. It's very, very important. What is the scope of the work? What is the nature of the work? That's very, very, very key. It's very, very key. Again, you see here the risk of material misstatements. The risk of material misstatements. I hope you can see that. I said that it's very, very key. The risk of material misstatements. Then, because it's the work of an internal audit, and the internal audits, they are kind of like in the organization, you know, we need to check the degree of subjectivity involved in the evaluation of evidence gathered by internal audit. Is there any subjectivity? Because even though these internal audit people are supposed to be like semi-independent, they are still in the organization. So the auditor would try to see like what the degree of subjectivity involved, you know, in the evaluation of evidence that is gathered by the internal audit. Now, let's talk about ISA 540. Let's talk about ISA 540, which is the nature of accounting estimates and the audit problem. Now, we've talked about estimates. And when we are going through the past questions, you saw estimates. Estimates being, I'm sorry, I feel like sneezing. You saw estimates being talked about, right? Being talked about. So, what does this mean? What does this mean? In the financial statements, estimated figures are used in situations where it is not practical or not possible to obtain a more precise measurement of an item. So an estimate is like an approximation. We do not know the exact thing, but we use an estimate. And so that produces risk. I suggest that you go into the exam understanding estimates. And I'm sure as I've led you through some past questions, you've seen it come, right? Very, very important. ISA 540 defines an audit estimate as an approximation. You see, as I mentioned that word, and there we see it. An approximation of a monetary amount in the absence of a precise means of measurement. So that's the book definition. Now, what are some examples of estimates? You have accruals, you have prepayments, you have depreciation. You know, these are all examples of these are all examples of estimates. The other complicated ones like provisions and all that. Estimates are made for the financial statements by the management of the entity using their judgment. So there's some subjectivity here. So, you know, the audit problem is very, very clear. So the auditor needs to be assured that, you know, these estimates that are used by management, are they reasonable? Are they reasonable? It's very, very important. Are these estimates reasonable? Now, you would want to understand the reasonableness of these of these estimates. Very, very important. Now let's talk about how to audit accounting estimates. Does anyone have a clue? How do you audit accounting estimates? And what do you think?
Well, so it depends on the particular item or the particular estimate you are going to look at. Because, you know, some estimates like warranties, as we looked at previously, you know, you need to look at probably the trend of the sales to know how much they can put as provisions for warranty. Or if you look at probably bad debt, you're supposed to also you can also, so bad debt is another item which you can also use probably external confirmation that, okay, because of so and so, this particular customer or this particular client will not be unable to, you know, settle the debt or so on and so forth. Or even with bad debt, you can look at certain legal issues which are arising as a result of the relationship that the organization has with that client.
Very, very good point. Okay, so how do you audit accounting estimates? Auditing accounting estimates include fair value accounting estimates and related disclosures. It's concerned with the audit of all accounting estimates, including those involving fair values. So in auditing accounting estimates, you are checking for reasonableness. These are general parameters. Reasonableness. And whether related disclosures are adequate. These are two things that the auditor must always look out for. It's very, very important. Now, again, I tend to give a lot more examples when it comes to accounting estimates. And all of you know, allowance for bad debts, inventory, obsolescence, warranty obligations, depreciation. You know, there are a number of them. Now, the auditing of procedures related to accounting estimates. As part of risk assessment procedures, ISC 540 requires the auditor to obtain an understanding of the following. Number one, the requirements of the applicable financial reporting framework. We need to understand what reporting framework is informing this estimate. You know, we need to understand that. That's one. Number two, how does management identify transactions or events that could result in an accounting estimate? How does management tell? You know, how does management identify those transactions that they say, oh, this transaction actually needs to be estimated, right? The auditor needs to also understand the nature of the estimate. What is the nature of the estimate? So that was what Caleb was talking about. It depends on the kind of the estimate that will determine the audit mechanism or the audit procedure. So I think, I don't know if Caleb saw my slides, but he was saying something similar. So in the case of a liability, this involves obtaining an understanding of the obligation for which an estimate is needed, right? For example, in the case of a provision for cost of warranties or guarantees, what are the terms of the warranties? You know, when you go and buy something, they'll tell you, they'll give you some terms. Right? That's what they call the fine print. They'll give you the terms of the warranty. What are the terms that have been given by the client to customers? Then the auditor also needs to review the procedures used by management to make their estimates. What are the procedures that have been used by management to make those estimates? Very, very important. Very, very important. Now, ISA 540, like I already indicated, I think I already mentioned this in the previous slide, right? Where I was talking about you need to ensure whether their estimates are reasonable and whether the related disclosures are adequate. So I've already talked about that in the slide. Any questions on that? Any questions? No questions? Everything clear?
Yes, sir.
Okay. Now let's talk a little bit about auditing of fair value. Of fair value measurements. Now, when there are issues relating to the auditing of fair value measurements, it's quite similar to auditing accounting estimates. What you need to know is that both are covered by ISA 540. Now, don't be scared about 545, this thing. There's no need to chew and pour these things. Now, the balances of items measured at fair value, such as property, are often significant in the statements of financial position. You can see why it is closely related to estimates, right? Why is it that fair value measurements and estimates, they are both covered by one ISA, and the issues relating to each of these are quite similar? Does anyone have a clue? Why is it that they are quite similar? Does anyone have a clue? Okay. They are quite similar is because fair value, it's because of the risk involved. Accounting estimates is based on the judgments of management. Fair value as well, you can't tell exactly how. It can also be risky, right? Because the management can put out a certain fair value for a property, that actually is not the case. They can blow it up if they want to, just like estimates as well. That's why, it's similar. The issues relating to fair value measurements and accounting estimates, they are very, very similar in that regard. Okay, so the auditor needs to recognize the audit risk in fair value measurements. Number one, inherent risk. Now, many fair value measurements are largely subjective and imprecise. Many fair value measurements are largely subjective and imprecise. And so, what does it create? There's an unavoidable inherent risk in their measurements. Fair value measurements have an inherent risk in that regard. In them, they are imprecise and very subjective. Now, what about even if you use valuation models, some of them can also be unreliable. So there's an inherent risk. Then control risk. There's also a control risk that the entity system will not be able to detect valuation errors. We can't talk about fair value without talking about valuation. So fair value measurements are often made by external experts, outside the normal course of routine business operations. So it's also possible that the entity systems will fail to detect valuation errors. So there's a control risk there. And also there's also a detection risk. We talked about these things last week. And this one lies with the auditor. The auditor may lack the knowledge and expertise to verify fair value measurements. It's also possible that the auditor may not be able to verify these fair value measurements because they lack the expertise and the knowledge. It's very, very important. Now let's look at this thing, which I feel like it's a bit important. So I included it here, the IAASB alert. The IAASB alert. The IASB issued an alert in October 2008. And it was basically to assist auditors by highlighting certain areas within the international standards on auditing that are relevant in the audit of fair value accounting estimates in times of market uncertainty. So in times of market uncertainty, fair value measurements could be very, very volatile, could be up and down, like it could be a mess, all right? So, we need to understand that, right? We need to understand that. So the IASB did this in 2008. So in times of market uncertainty, the IAASB sought to highlight certain areas. Now, it tended to focus a lot more on financial instruments. Just imagine the 2008 was it the market crash? Yes, I think so. 2007, 2008. You have financial instruments that are just moving up and down, up and down, up and down. Very volatile because the market is very, very uncertain during that time. So what are some of the key matters that were highlighted in this alert? Number one was the challenges faced in accounting on the basis of the fair value. What are some of the challenges that fair value measurements bring? And he also highlighted requirements and guidance. He also gave some guidance. And basically the initiatives of the IASB when it comes to matters relating to fair value measurement. So you see, fair value measurements can also be a very, very tricky area, just like estimates, because of the risk associated with this. Any questions? Sorry. Oh, what did I do? Any questions on that? Okay. Now, let's move on to Now let's move on to transaction cycles. Transaction cycles is a very, very key thing when it comes to audit. It's a very, very key thing. So in this examination, which is your ICA, you may be expected to apply your auditing knowledge to these transaction cycles. Now, when we say transaction cycles, these are lines on the financial statements, two-way transactions are made. So like revenue, purchases, payables, payroll, cash, inventory, basically lines in the financial statements. Those are transaction cycles. Okay. So you have the examination would test your audit knowledge in revenue, receivables, right? Sales and receivables, they go hand in hand. Purchases and payables, the payroll cycle, bank and cash, inventory, non-current assets. So we'll be taking some of them and we'll be trying to understand certain things about them, which is the control objective. What is the control objective? The key controls, the test of how do we test the controls, and what kind of substantive testing do we do on them? Oh, very important. Okay, so let's start with revenue and receivables. Revenue and receivables. What are some of the control objectives? The control objectives. When you think about revenue and receivables, what are some of the control objectives? Number one is there must be, because this is revenue and receivable, right? There must be proper authorization. There must be proper authorization and recording of customer orders. There must be proper authorization. And why is this necessary? If you get the authorization and recording wrong, your revenue will be wrong. Your revenue will be wrong. So there must be proper authorization. Proper authorization. Very, very key. Very, very key. Then also, revenue must be recorded for all goods or services delivered. Revenue must be recorded for all goods or services delivered. Also, all documents and records must be recorded accurately. So here you are more in terms of, accurate authorization and recording of customers, orders and all that. So the first point is what I'll focus on. There must be proper authorization and recording of customer orders, goods returned, and allowances, and allowances. Once you have that in place, it should help. Then what are some of the key controls? Now, we cannot talk about controls without talking about segregation of duties, right? Now, what is segregation of duties? When you have one person performing a bunch of duties, there's likelihood for fraud to happen. There's likelihood for fraud to happen. So the person who is authorizing the payments for something, shouldn't be the same person who is keeping the cash, because he can authorize something and take the money and claim that it is being paid for. So segregation of duties is key. So order acceptance and dispatch, these activities should be separated. Order